A trucking business making $400,000 a year just got denied for a $50,000 loan. Not because of bad credit and not because of no collateral. It's happening every day. It was because of a single field on a form that the operator filled out wrong. If you've ever been denied, there's a strong chance this same thing is sitting in your file right now. Today, I'm going to show you the actual system underwriters use to approve or deny trucking applications. Not the surface level stuff, the real factors in order. This is a full masterclass. We're going through identity, cash flow, the debt traps to avoid, and the exact steps to fix your file. Get a pen and paper. I spent 22 years behind the wheel of a commercial truck. I've seen the industry from the driver's seat in the executive office. Let's dive into chapter 1, the algorithm. Most operators think a human looks at their application. In reality, it's an algorithm. And if you don't speak its language, you're out before you even start. The first thing the machine checks isn't your score, it's your identity. Is your business registered correctly? Is your SIC code flagged as high risk? Many lenders see long-haul trucking as a red flag. If your business is listed under SIC code 4213, you're often in automatic denial, regardless of your revenue. We're going to break down how to structure your business identity to be lender-friendly without being dishonest. It starts with the Secretary of State filing. Your business name and purpose shouldn't scream high risk. If your name is Fast Freight Transport, you're already fighting an uphill battle against the algorithm. Another instant denial? Address mismatch. If your bank account address doesn't perfectly match your SOS filing or your tax returns, the system flags it as potential fraud. And stop using virtual offices or PO boxes as your primary business address. Lenders want to see a physical commercial location or at least a verifiable home base. Is your business listed in the 411 directory? Does your website look professional? If you're a ghost online, you're a risk to the lender, period. Next is the lifeblood, cash flow. Underwriters don't just look at how much you make, they look at how you manage it over a 90-day window. One of the biggest thresholds is your average daily balance. If your account frequently dips below $1,000, you're considered a high-risk borrower. NSFs, non-sufficient funds. This is the ultimate deal breaker. Even one NSF in a 90-day period can slash your approval chances by 80% instantly. Lenders look for consistent deposits. If you have one massive check but 3 weeks of zero activity, the algorithm sees seasonality and instability. They assign you a bank rating. A low 5 rating means you maintain a 5-figure average balance. That's the key that unlocks the best rates and terms. Now, let's talk about the silent killer, merchant cash advances, or MCAs. If you have daily draws coming out of your account, you are effectively unfundable for traditional equipment loans. When an underwriter sees stacking, multiple MCAs at once, they see a business in a death spiral. No matter how much revenue you have, the daily debt load is a red flag. If you're in an MCA, your goal should be to bridge out of it. We'll talk about consolidation later, but for now, know that this is why your equipment loan got denied. Lenders care about WH you're buying. In trucking, the age and mileage of the equipment are hard caps that the algorithm enforces without emotion. Most Tier 1 lenders won't touch a truck older than 10 years or with more than 600,000 miles. If you're buying old iron, you're going to pay high-risk rates. You also need to understand your lease structure. A track lease is standard in trucking, giving you a fixed buyout. An FMV lease might have lower payments but can cost you more in the end. A lot of people think their 750 score means they're a lock, but business credit is a different beast. Do you have a Paydex score? Are your trade lines reporting? A Paydex score of 80 is the gold standard. It tells lenders you pay your bills on time or early. Without it, you're just another guy with a high personal score but no business history. Lenders use your personal credit as a character check. They're looking for comparable credit. Have you handled a $50,000 loan before? If not, why should they start now? So, how do we fix this? It starts with a 90-day audit. You need to clean up your bank statements and your digital footprint before you ever walk into a bank again. Step 1, audit your Secretary of State filing. Ensure your address, name, and officers are 100% accurate and match your tax returns. Consistency is key. Step 2, move your primary business checking to a Tier 1 national bank. They have the best algorithms for equipment financing and report directly to the business bureaus. Step 3, get 3 to 5 business trade lines reporting. Fuel cards, parts suppliers, or office supply accounts. You need a verifiable repayment history. Step 4, Professionalize your digital presence. Get a real business email, not a Gmail, and a basic website that lists your services and contact info. It builds instant trust. Now, let's look at the financing nuances. Not all loans are created equal. You need to understand the difference between a zero down deal and a 20% down payment. Zero down sounds great, but it usually comes with a massive rate hike. If you can put 20% down, you're signaling to the lender that you're a serious, low-risk operator. That 20% isn't just a payment, it's equity. It protects you if the market dips and ensures you're never upside down on your equipment from day one. Also, consider the math of used vs new. A new truck loses 20% of its value the moment it leaves the lot. A 3-year-old truck has already taken that hit for you. If your goal is to scale to 5, 10, or 50 trucks, you need a different strategy. You need to move from being an owner-operator to a fleet manager in the eyes of the lender. Scale brings insurance complexity. Once you hit 5 trucks, your insurance premiums often shift to a fleet-based model. Lenders will audit your safety record more aggressively at this stage. Lenders love to see fleet management software. If you can show them real-time data on your fuel efficiency, maintenance schedules, and driver safety, you're a dream borrower for big capital. Finally, let's talk about working capital. An equipment loan buys the truck, but working capital buys the fuel and pays the drivers until that first invoice clears. This is where factoring comes in. It's not a loan, it's an advance on your own money. It's the fastest way to solve the 90-day payment delay common in the industry. Factoring fees are a cost of doing business. Paying 2% to get your money today is often cheaper than waiting 60 days and missing a truck payment or a payroll run. We've covered a lot today. From the algorithm to the debt traps to the scaling secrets. Trucking is the backbone of this country, and you deserve to be funded. Imagine your fleet growing, your revenue doubling, and your family's future being secured by a business that the banks are eager to fund. It's not a dream, it's a process. I spent 22 years on the road to learn these lessons. I felt the sting of denial and the rush of growth. My mission is to help you skip the pain and go straight to the growth. Your journey doesn't end with a denial. It starts with a better strategy. Take these lessons, apply them to your business, and watch the doors start to open. The capital is there. Go get it. Click the link below to download my full masterclass checklist. It covers every threshold we discussed today. Don't wait for the next denial. Get your file ready today. Let's get moving.